Hello, everyone. My name is Philip Palumbo. I'm the host of the Palumbo Podcast, where we interview some of the most successful founders of businesses, M&A attorneys, investment bankers, to learn about the best ways to exit your business if you're a business owner. Today, we have with us Terry Hannafin. Terry Hannafin is a partner at Carter Morse and Goodrich and has been advising shareholders of closely held and family-owned companies for more than 20 years to help them achieve their once-in-a-lifetime transaction. At CMG, Mr. Hannafin is responsible for leading the execution of transactions across a range of industries with an emphasis on manufacturing, consumer products, and business services, and directing business development initiatives. Prior to joining CMG, Mr. Hannafin was a managing director with De Fisher and Company and a family-owned business-focused advisory and investment banking firm, and held various positions at American Express and Morgan Stanley. So, Terry, super excited to have you here today. Thanks for your time.
Thank you for having me, Philip. Love to be here. Love talking about this, and love, as always, hanging out with you.
Yeah, same. Likewise. Always a lot of fun. So,
Yep.
Terry, so for my audience, for help them understand what investment banking is, what is it exactly that you do?
The term investment banking is really pretty broad. It can mean quite a few things to somebody from the outside. What we do within that broad landscape is really pretty narrow. And so, Philip, five years ago, if you asked me what I do, I'd say we are a full service investment bank for middle market companies. And you might nod your head and say, behind the scenes, what does that really mean? And so, and it forced us to sort of look inside and say, what are we really best at? What are we most passionate about? And where do we really want to spend our time and be best in class? So for us, investment banking is, we are sell-side investment bankers, which means we are working with owners of companies as they are thinking about the next step, or they're at some critical juncture in the life of the business or the life of the ownership group, and they're thinking about what's next. And so we work with owners on the sell side to help them, prepare for that, help them understand valuation ranges of what they might achieve in the market. We're in the outcome business, so not every sale looks the same, Philip. And then ultimately, we help them prepare. We work with folks like yourself, with lawyers and accountants, to get a team together to make sure that they are prepared for this once-in-a-lifetime event. And then we ultimately help them identify the right buyer or the partner on the other side and take them all the way through to a successful closing. And so for Carter Morse and Goodrich, we are sell-side only, and we only work with family owners and founder-led companies. And the big difference between that and, let's say, a private equity group is really the owner mindset, right? I think we'll talk about this a little bit more later on, but really, oh my God, I'm going to do this once. I need to make sure I do it right. And how do we best maximize this, as we call it, the once in a lifetime? Private equity owners of lower middle market companies, they're professional buyers and sellers of companies, right? They get into an ownership with the notion of exiting almost immediately. And so it's just a very different element around preparation, around mindset, around preparedness. Mm-hmm. And that's where we've really spent a lot of our time.
No, I love it. So I love how you guys use once in a lifetime transaction. I mean, it really is. And you think about it, and I think about it as an owner of my own firm and how hard I've worked to get to where I am today and where I want to go with the firm. And God willing, I think my children will come, or at least one of my three boys or two, or maybe some of my other employees have children, want to come into this business. And hopefully it's this legacy business that could be around for multiple generations. But you never know when you wake up one day, Terry, and you say to yourself, like, you know what, I'm kind of tired. I could get a very big bid for my business. So this once in a lifetime transaction, from the business owner's standpoint, what are like one or two key things that they should know if they're thinking about exiting their business?
Yeah. So, like you said, I mean, a lot of our clients, they're second, third, fourth, fifth generation businesses. They've been around for 100 plus years. We always joke, a lot of our clients have that picture of their great grandfather in the boardroom that's sort of still peering down on them, saying, yeah, old man Palumbo said, never sell this company. Exactly. Right? But here they are. There's a reason they're here. And it's not because somebody hasn't knocked on their door before or sort of lent in and said, hey, listen, I'd love to think about, if you're thinking about selling, we'd love to buy. Our clients have a stack of inbound interest, and they usually ignore it, right? Because of like you said, they're not thinking about an exit. It's their lifestyle. It's what they love and what they're passionate about. Or right? They're thinking about the next generation. But something happens along the way. You just said, you wake up one day, and a lot of our clients might just wake up one day, or there's an existential issue, or COVID happened, and gosh, that really sucked, right? I don't want to go through that again. And it took me a few years, and now we've built it back up. And in many cases, Philip, the apple, rolls farther away from the tree, right? The kids don't want success. The kids aren't interested in taking over the family business. And so,
Right.
there's something that happens. There's an inflection point around saying, all right, now I think now is the right time to really explore it. And so I guess, if we're talking about sort of, the advice I would give owners that wake up one day and are thinking about what should I do or how do I go about it, it's don't rush. Right? It's, we use a phrase here that is, tiptoe to the starting line, which is get ready, right? Which is spend the time to work with you and say, all right, if I'm going to sell this business, do I have enough? What's the right number to live my lifestyle? What does that look like for myself, for my kids, for my constituents? Go ahead.
Is that a big conversation that you would have with, I mean, I know from my standpoint as a wealth manager, obviously that's a big part of our conversation, but
Yep.
you as an investment banker, is that something you articulate to them as well?
Almost immediately.
Oh, that's great.
And so we always say, listen, if we close on a Friday, you have to know what that next Monday looks like.
Yeah.
Right. And so in a couple of different respects, because on that Friday, you still own the business, you have a considerable amount of illiquid wealth. You're still the person, you're the master of your own universe. On Monday, life's going to look very different.
Yeah.
Right. And so, what are you going to do with a meaningful liquidity event? Have you thought through trust and estates? Have you thought about tax mitigation strategies? Have you thought about legacy concerns? Have you thought about who's the right next owner for the business? Have you thought about your role in the business or not, and for how long? And so we spend a lot of time trying to paint the picture of the day after, because that tends to be our North Star at the end of the day, Philip, which is working with you and saying how much, what's the right, what's the number is kind of what I would say. And if they have a lifestyle that would require X, and we frankly think the business is worth something less than X, that's something we should know early on.
Absolutely.
Right. And so, and then that's so important for you to work with these folks. So it's a very early conversation that we have on the wealth planning side. And then there's getting your house in order, right? There's the legal and the financial and all those other things to be prepared to go to market. So when I say tiptoe to the starting line, these are all, getting back to your original question, these are first time sellers, only time sellers, right? And so think about who's going to be on the other side of that conversation. It's going to be a big public corporation, or likely a well-oiled private equity fund that does this all the time. And so if they're arming themselves, right, with, and what they want from a diligence perspective, but they're going to show up with their law firm and their CPA firm, and they're going to give your company a really thorough evaluation. And when surprises happen during that evaluation, that's usually not good for an M&A process, right? So part of our tiptoeing is making sure all of our contracts and our legal and all the things on the commercial side of the business are in place. It's making sure that the numbers we present are rock solid. And so, Philip, you've probably heard the concept of a quality of earnings report.
I was going to talk to you
Those
about
those are critical, and the buyers are going to do it themselves, right? And so many of our clients say, if they're going to do it, why should I do it? You say, well, do you want them finding out the warts, right, after you've negotiated a price, or should we find that out in advance? Then we've got time to fix it, explain it, amend it. If there's something critical, we can hit pause on the process and address it later. And so it's all that critical aspect. And the last one too is management team, right? If buyers on the other side, Philip, they're in the people selection business as much as they are the business selection business, which is they'll never know how to turn on the machine or run a process or manage a company quite the same way as owners and the management team of a seller would. And so there's a really critical component to the management continuity aspect of it that has to be accounted for, right? So if the buyers are coming in and I'll give an extreme example, they don't think anybody's going to show up the day after they close, that's an issue, right? And they'll solve for that during the negotiation. So there's a lot of things, Philip, that we cover early on, but it's wealth planning, it's your commercial and your business diligence, it's the numbers, it's the trust and estates, and it's the people side of it is critical as well.
Absolutely. And that's why, and you've said it before, and we've talked about this, and this is a big part of the product I'm putting together for helping founders as it relates to their exit, is having a dream team around them so they could prepare on everything you're just talking about, like investment bank, the attorney, wealth planner like myself, estate and trust. Because this way, like you said, once they tiptoe and they get to that starting line, to get over that finishing line and make it as clean as possible, it's important to have that dream team. So like for me, I spend a lot of time, like we spend time together, we golf together, we hung out together, and many that are on my team. So, we went through the process to feel really comfortable that you're the guy to help my clients with any investment banking related situations. And that should be for everybody. So when clients go to us, they know that you have a dream team that will help them, power through.
I love the dream team. We call it the core four.
Okay.
Right. And it's again, it's you, it's us, it's a CPA, and it's right, and everything on the tax side. But there's 30 other professions that you might need,
Yeah.
that are nuanced but yeah, we call it the core four.
You may need a psychologist for the personal side. Now, in all seriousness, though, right? So
you're right.
You sell your business on Friday, and we've seen this all the time. And so on Monday, how does that person feel? So those who are listening, they're thinking about selling their business. What have you experienced? They sell their business on Friday, Monday, it's a different lifetime. It's a different life for them. What have you experienced with that? And what can you advise on as it relates to that?
I think every Monday is different for everybody, right? We have some owners who have gone from operator to governor, right? They're family owned, but they're no longer family run. And so they're effectively, they're passionate and they're very tied to it, but they play more the role of investor and like a chairman of the board, right? So their day-to-day might not be so different, if you will. Right. We have others who are, the sale is effectively a recapitalization and their days don't change at all. Right, they're going to reinvest significantly. They don't want anything to change with respect to their day-to-day, but the sale is effectively an exercise to bring in a new supportive shareholder, a private equity group, that can infuse the business with a growth strategy and access to really deep pockets and access to new people and bringing in an industry board. Right. And that's a very different mindset. So in some cases, you have some that want to hand off the proverbial keys and go out to Montauk and, have a couple of cocktails, right, at Gurney's. Others are saying, listen, I'm in for the next run. And this is an opportunity to provide an off ramp for some passive shareholders while sort of realigning and reconstituting the equity base with a group that's only focused on growth. And so those Mondays might look a little bit differently. But what I would encourage is everyone to really think about that Monday.
Absolutely.
And, I called it our North Star, but the markets are really efficient, Philip, where if we had an owner that said, and he was an owner operator and said, I'm not doing, I want out of here as soon as I can, that's fine. But that's a different buyer that's going to come in that's going to be okay with that. Definitely. That's a buyer that's going to come in and say, I've got that person. Right. I've got a cadre of executives, or we're a big strategic buyer and we've got folks from a different division and I can handle that. A private equity group thinking about a new platform, they need people to stay. And so continuity is going to be very different, but it's a very different governance dynamic the day after, even on that recapitalization. Now you've got board meetings, you've got different reporting dynamics, you've got somebody to answer to at the end of the day. So there's an element of soul searching. I would say we encourage all of our clients to reach out to folks who have done it already. Right? Go talk to somebody who's gone through a recap. Go talk to somebody who's kind of been in your seat before to understand how they felt the day after. There's a lot of studies around seller remorse, also around, and I'm sure you've seen a lot of them. And I think there's so much identity tied to owning a business, right? And so not having that can feel, I think there's, in many senses, there could be a sense of, this decoupling and, is kind of a difficult thing day one, right?
Yeah.
Over time that can obviously subside, but the emotional side really runs the gamut, Philip.
It really does. And that's why, I think professionals like us, when we have these great relationships and people trust us, it's important for us to sit with them separately outside their business, like take that step back and ask them, what's the vision for your life now for the rest of your life? What do you really want things to look like? And paint that picture, have that conversation, get into really great detail, like peel the onion back. Don't just ask one question. This way, that person is really sanguine about, hey, what do I really want to do in my business here? Do I really want to just hand the keys over, walk away, which I've been in situations like that. And that actually worked out really great because sometimes industries have really tough regulations. They don't want to deal with it anymore. It becomes challenging. And if they can get a really good bid for their business, then, many people are ready. And then there are others, like you just talked about, that may want to just sell a percentage, which I want to talk about in a moment. But the bottom line is having a vision, taking the time to understand what that looks like, getting out of the weeds of the business is going to be super, super important. So that Monday is aligned the way you want it to be aligned. But
Yeah.
I want to talk about experiences that you've been through with founders of businesses and or business owners that say to themselves, I'm going to sell 30% to a private equity firm. And because I'm going to bet what that private equity firm is going to do to my business is really turn it around, enhance it operationally, because that's a big part of today private equity firms are doing. They're not really doing leverage, not playing the leverage game as much as they used to play. It's more about operational efficiencies and implementing that into a lot of these family-owned businesses that don't even have CRM systems, for example. And so they see the light at the end of the tunnel. I'm going through this right now with a particular client, and he's like big upside by selling 30%, leaving the rest in new company, and then hopefully seeing it thrive. Your experience with that, and do you see a lot of success when business owners make that decision?
That gets back to the recapitalization I mentioned before, which is, in many respects, there's, businesses might hit a ceiling for a number of different reasons. It could be talent capacity. It could be balance sheet capacity. It could just be experience capacity. And so, right, they're at that inflection point to say, how do I go further, faster? And maybe a private equity partner is the right solution at that point in time. I think you mentioned a good point, Philip, which is the markets are really efficient now, and it's hard. And for a really good company, if you go through a sell side process, you're going to have a market clearing price from going through a competitive bid process. And so there's only so much economic return that a private equity group can make from financial engineering using leverage and growing and things like that as perhaps it used to be back in the day. So I think there's over 6,000 some odd private, registered private equity groups right now. They each have a special little sauce. Correct. And they each have a value differentiator.
Correct.
Right. And there's 31 flavors of them. Some like distressed companies, some like high growth companies, some like West Coast companies, East Coast, big, small, machining, and manufacturing versus services based. Right. So because it's so diverse, right, really the exercise is around identifying not just the capital source, but the value added partner that might come in. Right. And let's go find that private equity partner or family office partner that's going to come in, and we know what this company is and we know what it needs to grow. Let's go find hand in glove that group that can come in and, they've done it before. They've got the playbook, they've got the people, they've got the networks, they've got the relationships, right? That becomes a really beautiful thing. And when you can identify those groups, and that's where we spend a lot of time before we go to market, is say, who's perfect for this situation? Now, all of a sudden they can see how they can create value, right, with this platform and continue to grow. So they're looking out 3, 4, 7 years. And that becomes a really nice outcome for the owner to sort of align with a group. And so there's the first bite of the apple and the second bite of the apple, which there's quite a bit written about. But that's just it's the notion of bringing in a partner is a good one when you've got that vision to what's next. But then identifying the partner that's aligned with that vision is when a lot of really nice outcomes happen.
Yeah, especially when you have, and the key thing you said before, and I love that, right, is that a lot of these private equity firms, they have the playbook that has shown consistent results. They're in that industry, so they know the industry. And for example, a client of mine right now who's going through that, he's aligned with a firm that knows the industry inside and out. And my client's very, very comfortable and
Yeah.
confident that this company, based on what they want to do operationally and what their playbook is, he's really comfortable that things can grow. So that's I think really, really tremendous. So how about mistakes that you've noticed or
Say
that they
it one more
should,
time.
yeah, what about mistakes that founders should be aware of as it relates to exiting their business? The top one or two most.
Yeah. I think one before which I would emphasize is, don't rush it. We are introduced to a lot of, we talked about tiptoeing to the starting line. The back end of it is once the gun goes off, sprint, right? Because time is nobody's friend in an M&A process, right? And so a lot of times we're introduced, and people always ask us who's our biggest competitor, and it's not the investment bank down the road, or in New York or Boston, it's usually the CEO that wants to try to go it alone. And so, they've been successful in every respect of their
True,
lives,
exactly.
right? They've negotiated big contracts and they can probably do a pretty good job at it. But I think, going it alone and not arming yourself with the dream team, right? And in many respects, somebody puts an offer in and they said, "Oh my gosh, I got a fish on the hook." I'm worried that this is a big fish. I'm worried that if I take too much time, or if I go bring in my dream team, are they going to come off the hook and go away? Right. And so many times that forces them to react. I'll just give them my numbers. They're not adjusted. I'll get right to a term sheet because I'm curious. And there's usually a lot that's left on the table, right? A process of one is not a process at all, Philip, right? In terms of knowing what a market clearing value should be for your business. And
Absolutely.
so, our advice, one mistake that we see a lot is they sort of, rush to give information to get a response from the buyer. And I can promise you that if they had sincere interest and you hit pause and you said, "Listen, this is really important to me. And I want to make sure, I'm a committed seller, right? I'm going to take time. I'm going to think through, I'm going to talk to Philip. I'm going to think about what's next. I want to make sure that this is right for me and my family and my shareholders." If that forces a really good buyer to walk, they were never a really good buyer in the first place, right? So a good deal today for them is a good deal in 3 months or 6 months, right?
Right.
So don't overreact to the sincere interest that's coming in. And then the second is invest in your success. And when you say the mistake, it's how do I, if somebody says to me, "How can I get out the quickest and fastest?" and how quick and for how much, that's probably not a great client for us at the end of the day, versus somebody who's going to thoughtfully think about the dream team and investing in their outcome and their success. And so I think the best piece of advice I would give business owners who are going to sell their company once, right, is act like a private equity group who sells hundreds of companies.
Yeah.
What do they do when they're going to sell a company? They know the M&A markets. They know they know accounting. They know, right? They build these things with the exit in mind. They're exit ready from day one. And yet, when they go to sell, they will still chat with the Phillips. They will still get a Q of E. They will still go through all of these preparations before going to market. Why? Because it's going to drive value. It's proven, and it will drive an outcome. And so if they're doing this on their 1 in 1,000, why wouldn't you kind of behave like that in your once in a lifetime?
Mm-hmm.
And it doesn't come cheap, right? I mean, there's a price and there's an investment, but that would be my biggest, advice, is sort of invest in the process.
I love it. I love it. And I loved how you're using all these great words today. I love it. So you used
Yeah.
exit ready. And that's the other important people to understand, right? When we talk to founders about exiting a business, it doesn't mean we're saying exit tomorrow. We're saying be exit ready. What we mean by exit
Yeah.
ready, you may be trading at an EBITDA multiple of 4. Your competitors may be at 7. Well, why aren't you at a 7? So what we need to do is we need to work with you to always be exit ready, so you're trading
Yeah.
at maximum value. We call best in class, right?
Yeah.
So that is so important people understand. So 1 minute response here if you can.
Yeah.
So to get somebody from 4 to 8, 7, whatever it may be, so basically to increase one's valuation, 1 or 2 key things they should be thinking about.
Every industry's got their own particular KPIs, right? If I was going to say, in 1 minute, Philip, have a growth plan. you get credit for momentum, right? And when you can paint a vision of your business and what it looks like in a year or two or three from now, and there's product development, there's people development, there's market development, you name it, whatever that is, that generates and that inspires confidence in your business, right? And so that confidence and inspiration, right, usually comes back into a valuation increase. And
Love
so
it.
that multiple you said a 4 versus a 7, right? That happens because somebody's got confidence in tomorrow, right? Somebody's buying tomorrow's cash flow.
Right.
They're not buying it. They're not buying that EBITDA yesterday. They're buying tomorrow.
Right.
And so when you have two businesses that have the same balance sheet and income statement at one point in time, right? It's what if you look through the curtain and see what tomorrow looks like, that's what's going to adjust the multiple
Love
in
it.
the eyes of the buyer.
Yeah, that's great. Terrific. And then finally, last question. Obviously, turmoil that we're seeing today, all the volatility with economics, tariffs, everything that everybody who's listening just knows about. What is it doing to the M&A market?
I think it's got everybody holding their breath. If we were to speak 60 or 90 days from now, I might have a little bit of a better answer. I think we're right in the middle of it. I think if you sort of go back, Philip, there's been headline whack-a-mole for the last couple of years, right? Geopolitical risks, supply chain issue, labor issues, and now, the election, and now tariffs. So I think at the end of the day, we think this too shall pass.
I agree.
It's scary right now because, when we're talking just before, I was talking about the confidence in the future. It's hard for an owner right now to tell a prospective buyer, I know what my steel input costs are going to be and my cost of goods sold. So I would say, take a breath. I think for our clients that might have some direct or indirect impact, we're saying don't overreact right now, right? Take your time. I think everybody has a knee-jerk reaction of wanting to put in a price increase or sort of react to all of these tariffs. I don't think we're done yet, right? And so, you don't want to run the risk of sort of missing the mark on any structural adjustments that you're making relative to consumer pricing or vendor pricing and things that are going to impact your P&L and your value and your income statement at the end of the day. So it's a bumpy ride for sure. I think folks that have direct impact from some of the tariff issues are holding their breath. I think there's some bright spots relative to services-based businesses that are in the U.S. that are not directly impacted. So, Philip, if you think about commercial and facility services and residential services, I think there's some places that are really going to shine while others are kind of in a wait and see position. So private equity groups still have to get capital to work, and I think they're going to be the short-term beneficiaries of some of the pause in other areas of the lower middle market here.
Great. Thanks for that, Terry. Actually, I do want to slip in one more question for you. And this is going to be a quick minute.
You got me all morning, Philip.
If we could do a quick minute on this too.
Yeah.
For my audience, a big concern that many people have is, okay, well, if I'm going to sell my business from a confidentiality standpoint, and or like, how do I break this to my employees so I don't lose top employees in this process? What type of advice do you give?
There's a couple of components to bringing in the circle of trust, right? And the way that we counsel our clients around it. One, it's a whole lot of work to get a deal done, right? And if you're trying to not let anybody know, you're now asking for files you don't normally ask for. You're now asking for information. So, people are pretty smart, right? They're going to catch on whether or not. And so, our best advice is, at the early set, right, bring in one or two key folks that can sort of be part of that circle of trust and help the process along, from preparing the company, explaining the company's values and things like that. I think it's immensely helpful for the blocking and tackling of a process, but also sort of developing the story. I think for the key folks, and you mentioned before around, I'm worried about flight risk, right? We're going to sell and somebody's going to say, oh my gosh, I'm going to leave. There's a really good opportunity, and what do private equity groups do if we go back to it, right? It's put things in place to retain these folks, right? So they know that, one, if there's trust there, that the owners are they're not going to explore a transaction unless it was good for the company, good for their people, and good all the way around. As I said before, people's almost the most critical aspect of this, right? So. And we don't see private equity groups or buyers slashing heads. We see them investing more, because a lot of our clients, they're missing that head of this or head of that or achieve this or
Right.
achieve that. There's more people coming in. There's more access to that. So, but on the flight risk, there's employment agreements or stay bonuses or things like that to make sure they're rowing in the same direction. And economically, an exit is good for them today, and along with, a new ownership group down the road.
Excellent.
So, and I would say, that's the key executive team. But, those can be put in place at the time of the transaction, but ideally, sometime before, if you're really thinking about it. Now you've got them on the team, and now there's more people grabbing the oar and pulling it in the same direction.
Awesome. Love it. Terry, thank you so much for today. You were very, very educational as always, right? Great perspective.
Thank you.
I really appreciate it. Look forward to continue working together, working with clients together. So thanks very much for your time today. I really appreciate it.
Philip, thanks so much for having me on here, and I enjoy watching your content online. So look forward to seeing you back on Long Island soon.
Thanks, Terry. Thank you very much.
Bye-bye now.